Presidents Trump and Xi meeting face-to-face right now for the first time in 6 years, seeking to avert a major trade war between the world's two largest economies. This high-stakes summit could reset global power dynamics as both nations navigate trade tensions, military posturing in the Pacific, and a race for technological dominance that will define the future of the world. Live from the Barclays Asia Forum here in Singapore, this is Insight with Haslinda Amin.
We haven't made a decision about December, and we're going to be looking at the data that we have, how that affects the outlook and the balance of risks, and I'll just say that.
Investors looking past a cautious Fed to price in the chance of a thaw in U.S.-China relations, with AI momentum also providing a tailwind. We speak to Robert Lighthizer, U.S. Trade Representative in President Trump's first term and a key architect of America's combative trade strategy. And as the U.S. and China battle for tech supremacy, we ask John Sawers, former chief of the UK's Secret Intelligence Service, how the rest of the world should navigate the tensions. And meanwhile, Nvidia achieving a historic $5 trillion market cap as CEO Jensen Huang's spree of deals catapults the AI frenzy to new heights. Barclays Bank President Stephen Dainton will be joining us with his perspective on whether or not it is a bubble. Our top story today, high-stakes negotiations in Busan, South Korea. As Presidents Trump and Xi meet for the first time in 6 years, the leaders of the world's two largest economies struck a cordial tone before they sat down to hammer out the details of a trade framework that was negotiated over the weekend in Malaysia.
We will be having some discussions. I think we've already agreed to a lot of things, and we'll agree to some more right now. But President Xi is a great leader of a great country, and I think we're going to have a fantastic relationship for a long period of time.
Our joint guidance, China-US relations have remained stable on the whole. Given our different national conditions, we do not always see eye to eye with each other, and it is normal for the two leading economies of the world to have frictions now and then.
Let's go live to Busan now, and our Chief North Asia correspondent Stephen Angle is there. Steve, the optics look great. The devil's in the details.
Really? Yeah, and everybody was there. If you just looked at that table, you saw all the key players on the U.S. side, including Mark Rubio and, of course, Scott Bessent, the Treasury Secretary. You had Howard Lutnick, and you can see it all there. You had Jameson Greer, the U.S. Trade Representative. On the other side, you have the Chinese Foreign Minister sitting to the left of Xi Jinping. You also have He Lifeng, the Vice Premier, who was the lead negotiator in these trade talks that spanned the globe from Geneva to London to Kuala Lumpur last weekend, where they came to agreement on a framework of a trade truce, if you will. And so now they're behind closed doors. When the cameras were shuffled out of the room, they're getting down to the details. What could be a lengthy process today as Donald Trump wraps up his stay in South Korea and Xi Jinping just begins his visit to APEC and South Korea. So this is why, the world's attention is on these two gentlemen to see if they can kind of formulate a more lasting peace than just an extension and kicking the can down the road of an extension of the trade truce. Obviously, they have key issues that they've come to agreement on, but it doesn't necessarily mean the outstanding, long-term, competitive situation between China and the United States has been resolved, no doubt. But right now, it's a good sign that the two gentlemen are saying the right things. And I think some of the comments from Xi Jinping were most striking, where he says, it's natural for the world's two biggest superpowers, the two biggest economy in the world, to have some friction from time to time, and that they need to continue to have dialogue. And Xi Jinping sort of said, look, we've already had 3 phone calls, we've written each other's letters, and we've stayed in constant contact. Yes, it's been 6 months of some have described it as chaos after Liberation Day, but we've come to this culmination where the possibility and the threat of more tariffs potentially has been lessened by these two gentlemen finding some rapprochement.
Steve, it's no secret, right? President Trump has said he wants a complete deal. Essentially, that means those sticky issues will be dealt with later, maybe perhaps even the likes of the fentanyl.
Well, sure. That's something the United States has wanted through the Biden administration and through the beginning 6, 8, 9 months of the Trump administration. And that is fentanyl is an issue, obviously, in the United States. The United States has accused China of not cracking down on those illicit makers of the precursors for the drug and allowing those precursors to be shipped across the ocean, possibly into factories in Mexico that then make fentanyl's way into the United States. The Chinese have not publicly acknowledged that this is being tacitly allowed in China. And that is something the Trump administration wants Xi Jinping and the administration in Beijing to acknowledge and to crack down on. And in exchange for that, they would reduce the 20% added tariffs that the United States has put on China. Possibly, we've heard reports of down to 10%. We'll have to see. The devil will be in the details following this meeting that could last upwards of 3 hours today.
Right. Steve, thank you. Our Chief North Asia correspondent Stephen Angle reporting from Busan. Let's get straight to our latest developments in the U.S.-China trade talks with Robert Lighthizer, who, by the way, served as U.S. trade representative in President Trump's first-term cabinet. Robert Lighthizer, good to have you with us. First off, lots of optics, lots of posturing leading up to this meeting today. For you, how does a successful trade deal look like? What must be there for you?
Well, we have to think about it in two contexts. One, the economic context, and two, the national security context. And of course, technology is in both of those. So for me, ultimately, we have to maintain substantial tariffs because we have a very unbalanced relationship. We are transferring enormous amounts of wealth overseas, but specifically to China directly and through countries that they transship through. So we need substantial tariffs to get that back in the direction of balance. And then we have to think about the national security, the technology side of it. We have to make sure we're not making concessions that are going to hurt us in the long run. The president has to deal with the choke point issues, and the general secretary and the president both have their own choke point issues, so they have to deal with that. They have to make sure we are in a position where those choke points don't bring either of our economies to a halt in whatever term this agreement is. So those are the principal issues, the way I look at it.
You talk
and then,
about
of course, fentanyl, if the president brings up fentanyl.
You talk about national security. And the president has talked about negotiating Blackwell chips. Should Blackwell chips be on the table as he negotiates this trade deal? What's your take on that?
Well, I mean, I don't want to, second guess the president on that. We clearly don't want to transfer more technology to China than we have to, any more than they want to transfer any of their technology and their choke points to us. So it's going to be a balance. The president presumably will do what he has to do. But as a general matter, we have to realize that China is an adversary of the United States, and that we have to be careful what we transfer to them.
If there are concessions to do with Blackwell chips, does it essentially mean the end of export controls?
No, I don't believe that's true. I think export controls will maintain an essential part of U.S. Policy for a long period of time. They've been there for decades and decades and decades, and I think they will be there in the future. And I would say most other countries have export controls. China, for sure, has a whole system of them. So I think the question is going to be just what the terms are.
Lots of issues on the table: fentanyl, soybeans, Blackwell chips. What's key for you?
Well, to me, the most important thing is to maintain the tariffs and not give up technology in a way that will have an adverse national security advantage.
What is the U.S. getting out of it right now?
Well, I mean, I think we have to remember that these choke points that China had were quite significant, and I think there was probably a surprise by some in the U.S. economy just how strong they were and how willing to use them China was. So I think we have to get beyond the choke points, and we have equal ones that we could use on China. And then, of course, the president emphasizes fentanyl. The reality is that we lose about 100,000 people a year to fentanyl, and almost all of that is coming from China. And the general secretary could, if he wanted to, stop that. And I hope that's part of the deal. I hope that they do not just make an effort. China can stop the flow of fentanyl if it wants to. They don't have fentanyl problems in China, so they can stop it if they want to. So I think the way to think about it is we need an agreement that maintains security, leads to rebalance, and realize that this is only going to be something that's going to last for a period of months or perhaps a year or so, and then we're going to be back there and have to look at it again.
I asked because President Trump celebrated the fact that China is buying U.S. soybeans again. But China has always been buying soybeans, and the amount has been minimal compared to what it's bought before. So how much really is the U.S. getting out of it that it is a win for the U.S.?
Well, I mean, soybeans are an important part. They're an important product to our agricultural sector. They are about half of total U.S. exports. So it's important that we have China buy the soybeans. I don't think it measures up to the rebalancing or to the national security issues, but it's very important, particularly to that sector. And China has promised to buy them in the past, and sometimes they kept their promise, sometimes they didn't. So hopefully that'll be part of the deal. But to me, it's not as fundamental as some of these other things. It's important politically, but it's not necessarily as important as the tariffs and the national security issues are. But I understand what the president's trying to do here.
What's also key for the U.S. has been the trade imbalance. But the question really is, how do you address that trade imbalance if there are curbs on U.S. investments, Chinese investments in the U.S.?
Well. I mean, I don't think the two are particularly related, right? We ought to have balanced trade with the world. We for sure should have balanced trade with China. They are a geopolitical adversary, and we shouldn't be in a position where we're sending them $200, $300, $400 billion a year in trade surplus and in technology. So, and in terms of investment, it's a question of the kind of investment you want from China. You don't want China investing in your technology because it's not secure. So I don't think the two are related. I think you can for sure get trade under control without having China invest in the United States.
Should President Trump ease those restrictions on Chinese investments?
Yeah, absolutely not. No, I hope that he does not do that. As I say, I'm not against all investment by China in the United States, but I certainly am in the kind of things they want to invest in. China is making a decision when they invest. They want to invest in technology and they want to get data. And those are two things we shouldn't be sharing with them. We shouldn't be sharing data with them because it educates AI, and we should not be sharing technology. So I hope he does not ease those, or at least doesn't. And I'm comfortable that he won't ease them in a way that's a threat to the United States. The president is very, very knowledgeable about this thing.
So in which areas should Chinese investments be accepted,
Well, in the first place, I wouldn't encourage it at all. But in the second place, if you said, low-tech kinds of manufacturing and the like, then it's conceivable. But it would have to be something where there was low-tech and low data. So I don't think we want to encourage it particularly at all. And by the way, there's no reciprocity at all there. China only lets us invest in things that they think is in China's interest. They don't let us go in there and invest in their technology and the like.
There has been suggestions of a sovereign wealth fund in the U.S. Are you for it? And the number out there has been about $1 trillion.
Well, I've heard that, and I always had this sort of view that if you have a $35 trillion deficit or national debt, it's hard to have a sovereign wealth fund. It seems to me the sovereign wealth fund ought to be after you pay off some of your debt. So it never made much sense to me. It is logical to say that businesses that benefit from U.S. subsidies and from U.S. technology, government technology, should pay something back to the government, to the people. So, and that's something the president believes, and I agree with him on. But the notion that we would have this giant sovereign wealth fund, I'm inclined to think we ought to pay off our debts before we worry about something like that.
Before we let you go, just one final question. Given developments that we're seeing right now in global trade, is a decoupling between the U.S. and China inevitable in the end?
Well, I don't think you're going to see decoupling. I think you're going to see strategic decoupling. You're going to see, hopefully, a relationship which is balanced, one in which security technology is independent, and in which investment going to and from is in the interest for us of the United States. That very much is the Chinese policy towards the West. They want to use trade to get big surpluses. In their case, they maintain their technology and want future technology to be totally independent of the West, and they control ingoing and outgoing investment. So I think we ought to have a policy of strategic decoupling. China clearly is implementing one, and I think we're going to end up having it.
Robert Lighthizer, thank you so much for joining us today. Robert Lighthizer, there, former U.S. Trade Representative. Of course, we're coming to you live from the Barclays Asia Forum. Still ahead, more from the summit here. John Soros will be joining us to discuss the potential national security implications of a U.S.-China trade deal. Keep it here with us. This is Bloomberg. Welcome back to Inside, where breaking news. Of course, this is one decision we've been waiting. The BOJ decided to stand pat, no change in terms of its normalization. We have the BOJ voting 7-2 to hold rates the same as in September. The big question really is whether it will move in December. Of course, earlier we spoke to Haruhiko Kuroda, the former central bank governor of the BOJ. Let's take a listen to what he had to say.
Now, the impact appears to be less than concerned about a few months ago, so that I think they would restart normalization process.
Kuroda, they're saying perhaps that, everything's in place. Normalization should continue in Japan. Now, as we speak, we're keeping a close eye on developments in Korea, where the U.S. and China are in talks. President Xi Jinping meeting with President Trump. Let's get perspective on U.S.-China security concerns around the trade Dainton with John Soros, former chief of the UK Secret Intelligence Service. He also served various diplomatic roles, including as the UK's ambassador to the UN and special representative in Iraq. Good to have you with us.
Thank you, Haslinda.
First of all, this trade deal that we're all anticipating today, tomorrow, perhaps even the days ahead if it doesn't happen today. What are the implications in terms of U.S.-China relations?
Well, I think it's been clear for some time that President Trump and President Xi wanted to find some form of accommodation, primarily on trade and on the economic relationship. Certainly the moves that the Chinese have made on rare earths really caught America's attention and showed that China had leverage over the United States, as well as the United States having leverage over China on things like semiconductors. So I don't think we're going to see a sort of warming of relations. I don't see relations between US and China ever being warm in the coming period. But I think this does seal off, if this deal happens, and I expect it to happen, I think this will address a series of trade irritants between the two countries. But both sides know the other's got a lot of leverage over it. So they'll proceed cautiously, carefully. Neither side wants to have a direct armed conflict, that's for sure. This doesn't have a direct impact on the security issues in the region, on the South China Sea, on Taiwan or whatever, but it creates a climate where there's not mutual hostility on the trade front.
But the thing is, longer term, it changes very little, right? Relations will always be dogged by all those issues, including Taiwan, including rare earths.
I think that's right. There is a systemic rivalry between Western countries and China. China is a communist system, and it's not trying to dominate the world in the same way that the Soviet Union was trying to dominate the world, but it certainly wants to dominate its region and its space, and that includes effectively taking control of Taiwan, of dominating the South China Sea, and that's not in the long-term interest of the United States. Now, whether the United States is prepared to do what is necessary to uphold Taiwan's democratic system, we'll wait and see. There's a lot of uncertainty on that score. I think the Chinese feel if they wait long enough, Taiwan will fall into their laps, because under this administration, certainly, the United States does not look as though it's willing to reach out and defend Taiwan. So we'll see how all that develops.
John, it looks like this is a China that's more confident, right? Because it feels like it has the leverage, especially with rare earths. The curbs it imposed recently was a pretty offensive move.
Yeah.
How are you reading it? I mean, how worrying is it for the world?
I think the Chinese really do believe that the East is rising and the West is in decline. I think they believe there is change underway in the global system, so that China can reestablish its leading role in the global economy, which it had for most of the last 2,000 years, the last 250 years, when Europe and America have been the dominant global economies, is an exception against the norm as far as the Chinese are concerned. The Chinese feel that they're coming back. I think the global financial crash meant that they were less in awe of the Western Western economic model, and believe that their own system is more effective. And certainly, they have shown by their strategic investments in rare earths, in renewable energy, in robotics and so on, and other technologies, that they can direct investment and direct the state-owned industries in China, so that they can create a dominant position which gives them leverage over the West. So I think that's what we're seeing at the moment, and I think the very competitive, aggressive approach that both sides, frankly, have taken over the last few years, I think we'll continue to see that.
We heard from Robert Lighthizer earlier. He talked about strategic decoupling between the two sides. What might that mean for the rest of the world? I mean, countries in this part of the world have resisted taking sides between the two. I'm just wondering, maybe they could be forced at some point in time.
I think we've seen over the last few years, not least in the pandemic, that we have a range of dependencies upon China, and China has a range of dependencies on the West. And both sides are really resolved to reduce those dependencies. I don't think it goes as far as decoupling. I think Ursula von der Leyen, the European Commission President, captured it when she talked about de-risking the relationship. Now, to what extent de-risking is actually happening is debatable, but I do think that both sides are going to reduce their mutual dependencies whilst continuing to trade and do business with one another elsewhere. I mean, the fact is, China is an economy in purchasing power terms roughly the same size as the United States. Every economy in the world needs to deal with China as well as with the United States. You can't completely decouple the two systems, but I think you can reduce your dependency, reduce your vulnerability to the other side.
John, great perspective. Thank you for joining us.
Thank you, Haslinda.
John Soros, former chief of the UK Secret Intelligence Service, will be staying with us. Let's take a look at where we are in terms of the benchmarks here in Asia on the back of that backdrop. What's happening in Korea as the two sides, the US and China, hash out those trade deal. We have the MSCI Asia Pac Index up by about 0.3%. Keep it here with us. This is Bloomberg. back. You're watching Inside. We're showing you live shots, I think, of Korea where the two leaders, Xi Jinping and Trump, are negotiating. We are expecting a trade agreement. Of course, Trump has said he wants a complete trade agreement. A lot of things on the agenda, including fentanyl, including soybeans. And of course, I've heard Trump saying recently that the Blackwell chips could be on the agenda as well. We'll continue to bring those conversations to you as developments come along. For now, let's continue our conversation with John Soros, former chief of the UK Secret Intelligence Service. John, increasingly we talk about the new world order, but am I wrong to think that there's actually no world order as the US pulls back from its role in the world?
Well, certainly whatever order there is going through a rapid change. For the last 75 years, we've been building up under US leadership a system of rules on trade, rules on how countries deal with one another, how they settle disputes, avoidance of use of force to change borders and those sorts of things. It's been eroding for the last 20 years or so. The Russian meddling in Ukraine in 2014 and then the full invasion of Ukraine in 2022 was an example of that. And I think what the United States has done is it's stepped back from the rules-based order that it largely authored, which is of huge benefit for the United States. And the United States has been the biggest beneficiary of the old order. So it is a bit of a surprise that the United States has turned its back on it so completely. But that doesn't mean there's not a world order. There's still major powers who compete with one another. There are still conflicts around the world, and there are means of containing those conflicts, as we've seen in the Middle East, as we've seen in Africa. And so I think it's a different order, which we all have to sort of get our heads around. And it's a erratic one. It's one which is very personalised around the personality of Donald Trump, who's done some good things like the Gaza peace deal, where he made a direct intervention. I think some of the other peace deals he claims is he's just given a sort of blessing to the outcome rather than actually help forge it. But we all have to adapt to this changing world, because the old order was in place for 75 years, and it sort of reflected the world of 1950 rather than the world of 2025.
You talk about the Gaza peace deal. Is that still intact? Because we're already getting reports of Israel continuing its attacks.
Well, phase one of it has been has made some progress. There's basically a ceasefire. Hostages were released from Gaza. Their misery coming to an end. A lot of Palestinian prisoners were released. And so there was definitely progress there. The next phase of getting Israel to withdraw from Gaza, getting Hamas to disarm, getting an international stabilization force and a new administration there is a much, much bigger and more challenging task. And it's a pity that President Trump has, he's got other things to deal with. And getting a deal with Xi Jinping in strategic terms is more important than the outcome in Gaza. But it's going to require sustained engagement by the United States and by other countries to get the Gaza peace deal to the next phase. I fear the outcome in Gaza doesn't look very promising at the moment, but at least the hostages are out. At least there's the makings of a ceasefire. And we've had for the first time, really, since President Eisenhower, a US president who's prepared to push back against Israel and to use some of America's leverage on Israel in order to make progress. That is a difference from what we've seen before.
The thing is, there's so much distrust between the two sides. Can you actually get a deal?
Well, there's a huge amount of distrust because the two sides have been, kicking kicking one another really hard.
So is it realistic to think that can be peace, a lasting peace?
I think that there can be. There's been lasting peace between Israel and Egypt, between Israel and Jordan. We've seen developments between Israel and the Gulf states, the Abraham Accords, cooperation with Saudi Arabia and Israel. So there's some progress has been shown. The Palestinian issue has very deep roots, and the reality is that both the Israelis and the Palestinians have almost connived with one another to avoid it being solved. There was a common ground, really, between the Israeli government of Netanyahu and the Hamas leadership under Sinwar, that neither wanted a two-state solution. Ultimately, a two-state solution feels a very long way off at the moment. But if you can't solve a problem, you have to manage it. And by managing it, you need a political process which gives both sides the sense that there's a light at the end of this tunnel, that for Israel there's a possibility of being accepted in the region fully with secure borders, and for the Palestinians that they have their own rights, their own sovereignty, their own self-determination. It's not impossible to imagine a peace, but politically at the moment it's extremely difficult to get there, so you have to just create the processes which contain the level of violence and limit the level of violence so there's some possibility for politics to play its work.
John, thank you so much for sharing your perspective on Insight. Thank you for your time. John Sawers, former chief of the UK Secret Intelligence Service. Now, still to come on the show, our coverage continues from the Barclays Asia Forum as we speak exclusively with Barclays Bank President and Head of Investment Bank Management, Stephen Dainton. Keep it here with us. This is Bloomberg. Welcome back to Inside. Blackstone's vice chairman says the alternative asset manager is still a big believer in private credit, despite warnings of a brewing crisis in the market. Speaking to us here at the Barclays Asia Forum, Thomas Knight also shared his insights on the U.S. economy and the Fed.
Their job as the Fed is to balance this issue of unemployment, and you don't want to be too far behind the curve. And so what I think the Fed is trying to do it just enough to keep a lid on unemployment and not allow it to shoot up in inflation. I think so far, to date, they've done a pretty good job. But listen, the chairman's got a very difficult job trying to manage this, and so I do predict today that he's done a pretty good job.
Now, we talk about those trade deals which are being negotiated right now that has trickle effect into inflation. People say it is inflationary, right? And in the end, consumers are likely to pay for it. If you take a look at the U.S. economy, might that inflation be at 4% on the back of the tariffs, on the back of those trade deals?
So we are watching this in real time. The impact on consumers is yet to be seen. I mean, listen, we believe the economy is quite healthy. As you know, we own 270 portfolio companies. We just announced our earnings this week. We had great earnings. We had $50 billion of inflows of new money. We have probably $200 billion of dry powder. We feel really good about where we are today economically. And as you know, because you reported, the IPO market's open. So we're seeing a bunch of realizations. We saw that at Blackstone this quarter, a bunch of IPOs. We think fairly good in the fourth quarter as well. So we see the combination of our portfolio companies doing quite well, inflows coming in quite nicely. So the combination of that would suggest the economy is still investment thesis.
All excited about the private market, and the conversation around the private market is actually private credit. Those cockroaches, where do you weigh? I mean, the likes of HSBC now putting aside hundreds of billions and millions of dollars just in case.
We are fundamentally a big believer in the private credit market. And the reason why people keep giving us capital, they understand both the thesis of what we want in private credit, which is long-term returns. And as you know, it's performed better than the liquid markets. People understand that. It's about the underwriting. And not to be that guy, those deals that you talk about, those were bank-led. I mean, again, not to be that person, but the reality, this is the private credit market, if you underwrite correctly, which we do, as we focus as we do for the long term, and the insurance companies that are giving us capital understand who we are as a firm.
It is opaque. It's an opaque market. It is illiquid. And we have the likes of Andrew Bailey saying, you know what, I'm going to stress test. That must say a lot.
We've been in this business for a long, long time. We care deeply about this business and why our clients are, obviously sending us money to invest in the private credit business. So we believe in it. We think it's important. We'll be doing it 20 years from now as we were 20 years ago. So again, the market's a great market. Investors understand it.
That was Blackstone Vice Chair Thomas Knight. Now, meantime, Nvidia has become the first company in history to reach a market valuation of $5 trillion. Optimism is also growing that a U.S.-China trade détente may reopen China's market for more of its AI chips. But the milestone also comes amid growing concerns that the AI sector is forming a speculative bubble. Let's get perspective from Barclays Bank President Stephen Dainton, who is also the head of investment bank management. Stephen, good to have you with us. First off, pretty exciting time. We're waiting for that deal to come through from Korea. What's your take on what's happening there and the possibility of the trade deal?
Well, firstly, thank you for having me, and thank you for having us here at the 19th Barclays Asia Forum, where you have 1,000 people collected here discussing many of these points. I think first and foremost, it's really important that the two presidents have come together. Many of the details of what will be talked about this morning have already been discussed and put in the press. I think if we can come to some agreement, a framework around not only rare earth, a lot of the tech products, as we've talked about here this morning with Ambassador Lighthizer, I think it should be very, very constructive.
Might that shape the way you invest? I mean, if tensions dial down within the U.S. and China, perhaps it makes sense to invest even more, because that has been, I guess, the big question mark for a lot of companies.
I think it's really important that we find some calm in the market. Obviously, we had earlier this year a moment in time where you had a number of tariffs imposed on countries that caused maximum volatility in markets. What you're beginning to see now is, as people accommodate the tariff imposition, is an understanding of how trade can be reopened with each other. In fact, even in the UK, you've seen the UK Prime Minister lead trade negotiations not only with the US, but also with India and Europe. And one would assume that the next phase is with Japan. So despite the tariffs being implemented, you are seeing an elevated number of trade deals. And I think capital flows will continue to accrete towards assets that are showing growth. And of course, technology is one of those.
When it comes to flows, capital flows, are you increasingly looking at, the flow coming from the U.S., coming to this part of the world? Is that how it's looking right now?
Well, I think certainly around Liberation Day, you had a huge concern around the dollar, and you saw the dollar decline. I think the dollar stabilized. Actually, it's accreted over the course of the last month or so. So I think that you are going to see capital trying to find growth. If you're looking for technology investments, the one place that you definitely want to look right now is in the US. But of course, there were some other regional opportunities. Europe, it is extraordinary. The European economies are relatively flat, and yet their equity markets are all performing extraordinarily well. In fact, the best performing market in Europe is the Spanish market, and Spain went through a lot of restructuring over the course of the last 10 years that maybe some of the larger economies in Europe are going to have to go through those restructurings also.
As you said, capital is flowing to the U.S., especially when it comes to tech. Nvidia now in the $5 trillion club. I mean, who would have thought? Is there reason to be concerned?
I think any industrial revolution, and we should not underestimate, this is an industrial revolution that is underway. And that isn't just the coding part of it, the technology infrastructure from a chip perspective. It is the power, it's the power supply and the entirety of the grid, which is why you're seeing data centers get announcements on Bloomberg almost every single day. So this industrial revolution is underway, without doubt. In any industrial revolution, you have assets accrete and decline. So I think that you're in the very early stages, first 2 or 3 years, of a significant amount of capital being pushed into this. And when you look at what the hyperscalers are doing, they're spending their cash flow. Remember, these companies generate enormous cash flow. That cash flow is being able to now invest in the next cycle. And you've heard a number of the CEOs make comments around their capex and their intention not to miss out on this reindustrialization process.
But the benefits have yet to be realized. I mean, you're investing in what could be rather than what's already there. And with companies like Nvidia prepared to spend hundreds of billions of dollars, surely there are risks involved. And how are you assessing that risk?
Look, I think in any industrial revolution, you're going to see capital that actually doesn't make a return. We've seen that in numerous industrial cycles, the rail cycle, the PC cycle, the internet cycle that we saw in 2000. Howard Marks here today making the point on 90% of the capital has disappeared that invested in that initial industrial revolution. So any industrial revolution is going to have marginal capital that comes in late in the cycle. But what you are seeing is a very intentional investment process from the hyperscalers. consumers in the next phase of this journey. Not only, as I said, in the technology chips, but also in the application layer that we haven't yet seen. The application layer hasn't even emerged. So I think that's the exciting part.
Shouldn't capital also be flowing to Chinese technology? I mean, the DeepSeek moment is a telling sign.
I think the DeepSeek moment was a very important moment. It raised awareness to what is going on in China. 18 months ago, many people were saying that China was uninvestable. I think that was a very short-sighted premise. And what you've seen this year with the performance of the Chinese equity markets is a reflection actually of the investment and the growth that is being undertaken there. So I think that China itself is going through an industrial revolution in technology and is a major competitor in global technology.
Is it being underappreciated? I say that because we heard you just say moments ago that if you're looking at capitalizing on the tech space, capital should be flowing into the U.S.
I think without doubt you have, you mentioned $5 trillion company in Nvidia. Actually, don't forget that Nvidia now has a larger market cap than the entirety of the UK stock market. So you're seeing these Goliaths emerge in technology. They're liquid, they're investable. So you've seen capital accrete to that from our clients. Without doubt, I think the level of transparency around the companies that exist in China is less. So you just have less of an investment thesis, but undoubtedly they're being invested in and they're changing rapidly.
You know, there's so many developments today to track. We forget that the Fed has just cut rates by 25 basis points. It pushed back on another rate cut in December because it's data dependent. It wants more clarity. Right now, the government is under shutdown. How are you reading the Fed's moves? I mean, what are the key takeaways?
I think importantly, they reacted. The market anticipates and analyzes the Fed movements very, very carefully. And I think what the Fed have done is bought some optionality. There were a few surprises on the dissenters. But I think that what Chair Powell has done is bought himself and the board of the Federal Reserve some optionality into year end. I thought his hawkish comments simply bought himself some optionality there.
I'm just wondering what a trade deal today might mean for the Fed. I mean, that would ease perhaps expectations of inflation grinding higher.
Well, there are two important parameters here. One is obviously the observation on jobs and I mean, we don't have any data, so we're sort of flying a little bit blind here. But importantly also is 3 the new 2. And the Fed understanding that premise between is 2% the target rate or 3% the target rate. Remember, the Fed has missed on its inflation targets over the course of the last 40 months. So I think there is a softening a little bit on the inflation front, but we'll have to see as the Fed analyze the data.
So the sense is that 3 is the new 2?
No, I don't think 3 is the new 2, but certainly...
We're not getting to 2, Stephen.
We're not getting to 2. It's a long journey. But I do think, when you consider what is the Fed's mandate, the Fed's mandate is stable and growing jobs and an inflation awareness and monitoring inflation to keep inflation stable. And I think between the 2 and 3 level, that's a pretty decent place for them to be.
There are lots of risks out there, and one that has emerged recently is in the private credit market. I'm just wondering where you sit on that. I mean, there are lots of big voices saying there is no reason to be concerned.
I think any time that you're later in an economic cycle, you have to be aware. Private credit is grown enormously over the course of the last 15 years to north of $1.5 trillion. But in each extension of credit, whether they're broadly syndicated or not, it's a parameter around the documentation that you put it and the asset quality. And I think that those two things, I'm not sure it's a delineation between bank lending or private credit. It really is the standards with which you observe the lending that you're undertaking. Undoubtedly, it's a very useful part of the toolbox, and we have a number of very talented managers. I would say that you do have a number of tourists that have emerged, as you do in any asset class, that emerges very quickly.
Some say that it shouldn't have happened because rates are low enough. And also, when you take a look at the U.S. economy, it is pretty resilient. It should not have happened in the first place. And by virtue that it did, it is a cause of concern. Do you agree?
No, I would say that in any economic cycle, positive and negative, you have impairment in a lending book. You just do. You can never legislate for fraud. And the question is, you will always have idiosyncratic credit events, but it doesn't look as though they're systemic in anybody's credit book. I think that that's very important. I think that the journey of credit over the course of the last 10 years has moved, however, from banks towards private credit managers, and we're both operating in the ecosystem very comfortably.
Stephen, it does seem like the world has learned to adapt and shift to all the changes. For Barclays, how is it viewing the prospects for 2026?
Look, I think we're very optimistic. We obviously just reported our earnings 2 weeks ago with Venkat. He reaffirmed his targets for this year. So on February the 10th, not only will he stand up and announce the earnings for Q4 and the full year of this year, but he'll also give some guidance on our targets for 26 and 27, which I think is a very positive step. We see no sign of a default cycle in the UK or anywhere else. But I think that our job is to be consistent. You know, we laid out a journey from 10% to 12% return on tangible equity with a core CET1 in the 13.5% to 14.5% range, and it's really about executing on that journey. But I think Venkat's assertion that he would point the market towards 26 and 27 very early in the new year next year is a very positive sign.
Stephen, thank you so much for your time today. Barclays Bank President Stephen Dainton here. Just to recap some of the headlines that have come through, and by the way, that meeting between Xi Jinping and President Trump has concluded in Korea. We're getting some lines from that meeting. Of course, we're showing you live pictures from outside the meeting venue. Trump says that they've already agreed to a lot of things. They could sign a trade deal today. He did say that Xi Jinping is a tough negotiator. He has said that before. He said that again. And in terms of the lines from Xi Jinping, he says that they don't always see eye to eye, but that is normal. As far as he's concerned, the U.S. and China should be friends, and that they are ready to work together to build a solid relationship. Again, of course, you're seeing live pictures from Busan, where those trade negotiations happened it started about 2 hours ago between Xi Jinping and President Trump meeting for the first time in about 6 years, I think. Already some lines suggesting that we can expect a deal today. On the table, a slew of sticky issues, including fentanyl, soybeans, and of course, of late, we heard from President Trump talking about Blackwell chips on the table as well. This is a key thing for Nvidia in particular, which says that, it's had no sale in China. If that does come through, there are questions about national security. Live pictures out of Korea. That trade deal could be coming today. We know for sure that the meeting between Trump and Xi has concluded. Now, before we go, here's a look at our guests for tomorrow. We'll get fresh insights on growing risks in the credit markets with Nuveen's macro credit head, Laura Cooper. Also, MasterCard's Chief Commercial Payments Officer, Raj Chidari, who will be joining us exclusively to discuss the outlook for fintech in Asia. And of course, starting next week, Insight is expanding to 2 hours of live coverage. We'll bring even more of our crucial insights and sharp analysis, including a spotlight of India's growing economy. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.